Moving averages are directional guides and speed up technical analysis of trends. That's what they do. Moving averages are directional guides and speed up the analysis of the charts. The type of moving averages does not matter that much. Meaning, should we use simple, exponential, weighted? I don't know what else. There's even other types of moving averages. Doesn't matter that much. There is little bit of a difference. Most people use either simple or exponential moving averages. Um, Exponential follows price pretty closely. So with any kind of move in price, the moving average will react also in a quick way, and so you can easily get shaken out if you are paying close attention to the moving average. And it's exponential, not simple. Simple, gives equal weighting to the last 20 closes, right? The close of the last 20 bars. Exponential emphasizes in the calculation the most recent close, so it follows price pretty what's the word, closely. So there's a lot of zigzags in it in exponential. So I like to use simple. I personally like to use simple, but if you like exponential because it sounds a little bit more sophisticated, go for it. But whatever you use should be on the same, whatever type of moving average you use, simple, exponential, weighted, should be the same on all time frames. Moving averages are superior tools in uptrends and downtrends. In sideways trends, their importance is of no use. There is one exception though, and I'll go over it in a minute. As you can see, in an uptrend, it's really nice when you have the 20 MA on the chart. In trends, uptrend, downtrend, beautiful. Sideways trend, price doesn't react to it, goes once it's broken, it doesn't react to it really that much. Up, down, do you buy here, do you short here? It's of no use, almost, in a sideways trend. But does that mean you should take off the moving average every time the stock goes sideways? Probably not. But in an uptrend or a downtrend, beautiful. Reacts to the 20 most of the time, not always, right? The exception is when stocks are about to transition up. The 20 MA will start to hug price and curl up. That's your indication that the stock is about to transition into an uptrend. So that's why even in a sideways trend, when the 20 MA is, I said, of no use almost, keep it on the chart, because when the stock is about to break out, you will start to see that the 20 MA will actually start to curl up a little bit. Now, why is it curling up? Because of the higher lows. That's why. But in this case, the higher lows here are very easy to spot, right? Other times they're not that easy to spot. Like here, if I didn't have the 20 MA on the chart, I may have not noticed that the stock is about to break out. But notice how while it's flat, while it's going through price, it was of no use. Once it started to trend up a little bit, right, to point up a little bit, and started to not let price go below it, that's when you knew the stock is about ready to break out. So that's when you play it if it breaks out, right? You see what I mean? While it's going through it, no use, but here, okay. So that's that's why it's still useful to keep the moving average and use the moving average, because it gives you a great heads up that the stock is about to transition higher or break out. The color of the moving average should be the same on all time frames, so you're not confused, obviously. So I use blue for 20, red for 200. Okay, blue 20, red 200. Notice again, flat, no use. As it starts to move up a little bit, boom, stock breaks out, and from here goes to $100. Actually 99.48, so $100. Now the direction of the 20 MA. A rising 20 MA represents positive market action or strength. A falling 20 MA represents negative market action or weakness. In a strong uptrend, retracements, I was going to say obviously, retracements tend to halt near their rising 20 MA. In a strong downtrend, rallies tend to halt near their declining 20 MA. Following penetrations of the 20 MA, once the 20 MA breaks, pullbacks to the now broken 20 MA become very likely. That's why when a stock breaks the 20 MA, it's a signal. It's not that, oh, this line in the sand that broke is, it broke the golden line. Not really. It's not like that, but it tells us something, that the stock is no longer getting bought the way that it was before. So again, the direction of the 20 MA is important. It tells you whether it's strong, the stock is strong or weak. And in a strong market, retracements tend to halt near their rising 20 MA, right? Once the 20 MA is broken, so retracements halt at the 20. Once the 20 MA is broken, now it keeps getting broken. It's it's of no use basically. The stock is changed its nature almost. All of a sudden was getting bought hand over fist. All of a sudden nobody's interested in it, and it all started after that break of the 20 MA. Okay, the slope of the 20 MA. The slope or angle of the 20 MA is indicative of the strength or the weakness of the underlying stock. 30 to 45 degree is ideal. Steeper would be not sustainable. Shallower means the stock lacks momentum or is not strong enough. If the 20 MA is going from the left part of the chart, bottom left corner of the chart, to the upper right corner of the chart, that's nice. So this is not exactly 45 degree, but that's what you want. When it starts to accelerate a little bit, notice how this is a nice angle, and now it's starting to go up and up, increase. That's when the trend is becoming a little bit unsustainable, and then boom. It's not magic. The 20 MA really does tell you that the stock is the momentum is becoming almost extreme and becomes unsustainable. This is gorgeous. Again, from the upper left corner to the bottom right corner is exactly what you want to see, and you want it to maintain the same slope. If it starts to increase, the slope starts to get steeper, that's a signal that it's becoming not sustainable. Notice how the stock drops or resumes the downtrend right off the 20 every time. Now, I'm not saying that every chart is going to be this clean, right? Not every chart is going to be this clean. But if I didn't have the 20 MA, would I know to short it here every time? I probably wouldn't. Would I? No, I wouldn't. The 20 MA makes my life easier. Big time. Again, nice uptrend, nice angle, and now it's becoming a little bit unsustainable. And in the stock, of course, it's indicative that the stock is going climactic. Okay? All right. This is an intraday chart versus this is a daily chart. This one. So it works on both intraday and daily time frames, every time frame. Odds are much higher when playing the trend. Odds are much higher in the direction of the 20 MA. The 20 MA must be going. So now a lot of people ask me, how do I scan for plays? How do I find the good ones? Here's how you do it. You want a 20 MA that's going from the bottom left corner of the chart to the upper right corner when playing long, obviously. Vice versa when playing short, from the upper left to the bottom right. You want price to be at or near the 20 MA, not far from it, not extended. Okay? You want the 20 MA to not be crisscrossing price, to not be going through price. You want the 200 MA, which we'll talk about in a minute, to be below price and not above it, with the exception being transition A. And the correct entry, when again scanning for longs, is almost always going to be at the rising 20. So it solves, so the one of the biggest problems that we have as traders is that we constantly have entries. Like, how many symbols did I just show you a few minutes ago, right? Like these, that's a dozen symbols almost. How do you know it's the right entry or not the right entry? Or how do you know whether it's the right location or not? Ask yourself, is price currently at or near the 20 or not? If it is, then that's the correct location. However, we do not enter because the price is near the 20. We also have to have a pattern. So if you have a pattern, and you have the right location, okay, now the odds are really in your favor. Now you're putting the odds in your favor. Okay. Now, some additional uses for the 20. The 20 can be used to expedite the scanning process, for sure, because it speeds up analysis of the charts, big time. To determine the stock's extension, as long as the price is maintaining a certain separation from the 20, that's fine. As the separation between price and the 20 increases, that tells us that the stock is speeding up and the trend is becoming unsustainable, right? So the farther or the farther away it is from the price is away from the 20, the more overbought or oversold. In other words, the more extended. You can locate support and resistance by looking at the 20, because we said in a downtrend, price tends to halt at or near the 20 MA, right? In an uptrend, the other way around. Price tends to halt at or near the rising 20 MA. You can also use the 20 MA to determine if there's a price divergence. Sometimes I can tell that the stock, I mean, you can never tell, so that's not a word that I like to use in trading, but you can start to suspect that the stock is not going higher, because you will see that the price may be making new highs, but the moving average is not. The moving average is still lagging behind, even though price is making new highs. That gives me a heads up. Be careful. There's a divergence between price and the 20. And you might say, well, I can use a MACD indicator or whatever to be able to tell there's a divergence. Yes, you can, but you don't need it. You truly don't need it. Correct. Assume is the right word. Barry, thank you. You can anticipate reversals. As I said, price almost always bounces off the 20 MA when it's in an uptrend, or the declining 20 when we have a downtrend, strong downtrend. So it's easy to anticipate reversals. You can also anticipate a rise in volatility. How do you anticipate a rise in volatility? Anybody know? This is something that when you're a new trader, you hear probably about a lot, or you read about a lot, which is, the moving average crossover. When this moving average crosses over the other moving average, always buy the stock. No, that's not what that means. In simple English, when the smaller, the shorter moving average crosses over the longer moving average, that means short-term volatility is increasing. So if the stock is basing, then it might be setting up for a breakout. That's what that means. So you can anticipate a rise in volatility anytime you have a shorter moving average crossing above a longer moving average, and I'll show you examples of that shortly. You can also calculate the reward to risk on the play using the moving averages, because a lot of times, just like the shop, or I don't know if the shop was going to be at the declining 20, but a lot of times I play a breakout on the daily, and my target is gonna be would be the declining 20 on the weekly or the monthly. I do that all the time. Most transition A plays on the daily chart, unless I'm holding them long term, but I wouldn't hold them long term if they have a declining 20. So most of the time, if I have a transition A breakout on the daily, my target is actually declining 20 on the next larger time frame, and in this case the weekly chart. If I play a transition A on the 5-minute chart, my target is going to be the declining 20 on the 15-minute. So I can use moving averages to locate support and resistance and determine my targets, my reward to risk. And you can use the moving averages easily to determine relative strength or weakness compared to the market. You know, you look at the stock that you're interested in compared to the market. The stock you're interested in may be above the 20, but the market is below it. Oh, that means your stock has relative strength. Maybe your stock is above the 20, but still under the 200, whereas the market is above its 200 moving average, but below its 20. That means the market has longer term relative strength to the stock that you're looking at, but shorter term relative weakness. So again, you can determine relative strength, do your relative strength, relative weakness analysis based on moving averages and many other uses. But I don't want to complicate it. I don't want you to memorize any of this. It should be mostly intuitive, right? And then after a while, you start to integrate the use of the 20 and the 200, as I will cover in a minute here, in your day-to-day trading. And it will help you tremendously. And you use it in an objective way, not in a, some mysterious way that some of the other indicators call for. When they say, okay, if RSI is above 1.5, always buy the stock. I would never say that about when it comes to the moving averages. When it comes to the 200, so we like the 20 to be rising or declining. When it's flat, it's of no use almost, right? When it comes to the 200, flatness is king. Truly, a flat 200 is what you want. While the 20 MA is most powerful when it's trending, the 200 is strongest when it's flat. Think of the 200 as a floor to stocks above it, right? And a ceiling to stocks below it. And a level floor is always preferable to a slanted one. Just remember that. Keep that in mind, okay? The 200 MA as a line in the sand. In general, stocks trading above the 200 are being accumulated. In general. Stocks below the 200 are going through their distribution phase. Below the 200 is the average price of the last 200 bars, of the last 200 closes, okay, on that time frame. So it's a longer, it gives you a longer view kind of whether the stock is being accumulated or sold. As such, in general, do not short stocks above their 200 MA on that time frame, because it could be above the 200 on the 5 and way below the 200 on whatever on the daily. So in general, do not short stocks above the 200 MA on that time frame. Similarly, don't buy stocks below their 200 MA on that time frame. Now, first way to use it, I guess in addition to what I've said so far, is as support and resistance. Support when price is declining towards the 200, and resistance when price is rallying up towards it. And especially is true if the stock was extended, right? Extend like up and into the 200. Probably gonna stop the stock dead in its tracks, probably. And especially if the stock is extended and has put in multiple green or red bars in a row to the 200 MA. Give you examples. This was a gap up. Drop, and almost goes vertical into the 200. Perfect. On the 5 and the 15, and the gap fill, and the rising 20 on the 15. What else do you want? This was called in the room as a long. I mean, that's the bottom. A gap down, rallied pretty hard into the 200 on the 5, on the 15. Pretty nice. Ended up being the top for the day. Here it is. Down a lot, goes almost climactic into the 200. To tell you the truth, the 200 MA, I mean the stock does not even need to be a really climactic play for us to play it long off the 200. As long as it's down multiple bars into the 200, especially on the 15-minute chart, I'm talking about the 15 in particular, I mean, you can almost close your eyes and buy it once it takes out the prior bar's high, especially on the 15-minute chart. I don't know why exactly on the 15 it works like this, but it works like magic. Up multiple bars into the 200 on the 15, it's almost always a short, and vice versa. So it doesn't have to be even really that good of a setup as long as it's up or down multiple bars into the 200. Now we can also use it as a gap strategy. This is something that I discovered on my own, not taught in the TPM class as a gap strategy, but I'll show you what I mean. Here's kind of the general guidelines for this. Buy at the open stocks gapping up just above a flat 200 MA on the daily chart, almost regardless of the quality of the gap. Whether it's novice, professional, high quality, low quality, almost doesn't matter. Short at the open, stocks gapping down just below a flat 200 on the daily. Again, almost regardless of the quality of the gap. Wait for a pullback to the 200 MA before buying the stock. Before buying stocks that gap well above the 200 MA. If the stock gaps above it by a lot, then wait for a pullback to the 200. And likewise, wait for a counter rally if the stock ends up gapping well below the 200, gapping down. Examples: gaps into resistance right to the 200, almost immediately gets bought. Gaps a little bit above the 200, notice the bottoming tail, that tells us it actually pulled back a little bit to the 200 and then got bought. A little bit above the 200, in this case the 200 wasn't flat necessarily, didn't matter, pulled back and stopped at that invisible line. Why does it work like this? Don't know. It's probably where all the algos are programmed to buy. It's where everybody is programmed to buy. You see how it gapped above the 200? It actually cleared resistance that day. Surprisingly, you would think, okay, it should go right at the open. No, it didn't. It came back, it came in a little bit, retested the 200, and that's where it was a good long. Again, above the 200, pulled back, didn't even reach the 200, but popped. See it? Again, don't ask me why, but it works. Even when it's not a flat 200, but flatness is king. When it's flat, it's best. And then in this case, the stock gapped into the 200. Guess what? Came in hard and then got bought off the 20, of course, at the gap fill too. Okay? This one gapped below the 200, right into support. Didn't matter. Flat 200, just below it, it dropped another 50% almost that day. 40 maybe. Because it gapped to 2, slightly above 2, and closed at like 125. Amazing. Just this was a little bit below the 200, so initially bounced up, rallied up to where? To the 200, and then came in. I mean, crazy stuff. If I didn't have these examples, you might not believe me. So I do pay attention when I see a stock gapping to or near the 200. I do pay attention, and if the stock is gapping just below it, I'm gonna automatically upgrade the gap. I'm gonna automatically like that gap, even if the gap wasn't all that great. This one actually gapped like right below it, but popped initially, and then it came back in and dropped. So this is not a very good example, but it is what it is. This was also gapped a little bit below the 200, was a good short that day. So as a gap strategy. You can also use it as a breakout strategy. Look to buy stocks in an uptrend that base at or near the 200 as soon as the rising 20 MA catches up to price. So this is not just the 200, it's the on the daily chart, yeah. This is not just the 200, this is actually the 20 and the 200, the crossover strategy, right? This is it. I'm going to show you what I mean in a minute. Look to short stocks in a downtrend that base at or near the 200 as soon as the declining 20 catches up. It works on every time frame, but I love it the most for swing and long-term trading. Here's what I mean. If you have a stock that's down a lot and is basing at that, is trapped between the 200 and the 20, and the 20 starts to point up, starts to cross over the 200, get ready. It's gonna break out. Get ready. Okay? Notice the stock was, in this case, basing slightly, well, initially was above the 20, but below the 200. Broke out. This was really the right entry. Another entry right here. Perfect. Amazing. Yeah? Take a look. They don't come much better than that. Now, ideally, I like it to base. So this is the ideal picture. I'm gonna draw it so you know what the ideal picture is, for me at least, based on my experience. So we'll switch over here, and I'm just gonna use this as a whiteboard. Ideally, I like to have the 200 flat, and I like to have a rising 20, and I like it to be pretty long, like so. The longer the better. And I like the stock to be oscillating between the 20 and the 200, the rising 20 and the flat 200. So you're getting higher lows and equal highs, and eventually it's gonna get squeezed. The stock is gonna just explode higher. So ideally, but the truth of the matter is, I've seen it happen where, you know, the stock is, you know, so here's the 200. Let's just say that's meant to be a flat line. So here's a flat line. I saw that you'd see the 200 like that. Price maybe might be above it or through it, and then as long as you have the stock is basing at or near the flat 200, and the 20 maybe was declining or flat and now is starting to point up like so, those are the best breakouts. Truly, those are the best breakouts, and the ones that lead to long-term trends. I challenge you to go back and look at how trends started. You will learn a lot, but you will also see that most of the time they're gonna look like this. The bottom is gonna look like this. Stock based at or near the 200 for a while, and then the 20 started to point up, and that's when it broke out and never looked back. They're gonna look like this a lot of the time. It's an incredible strategy. So again, notice how the 200 is here. It's like basing in the right area, but it's not basing exactly below it or above it. The 20 was flat and started to point up. And then, so where was the exact entry? Hard to tell here, but look at the move. So this is not a very pretty chart, but it illustrates my point that as long as the stock is basing at or near the flat 200 and the 20, that smaller moving average starts to curl up, get ready for an explosion. Right here it is, basing under the 200, the 20 started to point up. That was the entry right here. There was another entry right here too. So this is one of my favorite things to look for, or strategies, when it comes to long-term trading. And this is a picture perfect chart. They don't come much better. They don't at all. I remember calling it in the newsletter swing, and it went to $28, I believe. It went to the 30s, but we exited at 28, I think. So notice how the 200, the 20 is below it, and the stock is trapped between. And notice the shakeout right before that break, that explosion on high volume. That tells you that people did get shaken out. and the pattern got tighter and tighter, I mean, this is gonna break out. You can make big money on a play like this because the stop is pretty tight too, just under the 20, and then entries above all of this. So this is the crossover strategy, but I don't do it because it's not because of what people say on the internet about it. It's because I've seen it. I've seen how it works, and it's just an amazing strategy. Okay. Any questions about anything we've talked about? Any way to scan for a flat 20 or 200? I'm not sure. I'm sure there is a way to, like, if you can do some coding and programming. I'm sure there's a way, but I've never tried to scan for a flat 20 or whatever. You can scan in TC2000 for stocks above their 200, or you can scan for or above their 20, or you can scan for stocks that are trading in between the 200 and the 20. So you can scan like this, but if you want the 200 to be flat, if you want you probably need to